Hello everybody, how's it going today? My name is Joe Bedogne and I'm a real estate agent. This is the second installment into my first time home buyers video series. And if you are a first time home buyer, first and foremost, I want to congratulate you for coming to that decision. It's not an easy decision to make. And my job as a real estate agent is to guide you through the process, alleviate some of your anxieties, and ideally make it as smooth of a process as possible. So to that end, in this particular video, I want to cover a little bit about financing and lending and how you're going to obtain the money to purchase your home. Now, I'm going to look at it from a real estate agent's perspective and not from a lender's perspective. Keep in mind, I am not a licensed lender and I don't work for a lending agency. So that being the case, moving forward, I want to talk about a handful of things in this particular video. First, I want to talk about down payments. All right. Then I'll talk about what they call LTV, loan to value ratio. After that, I'll briefly get into closing costs. Just give you an idea of how to figure out in your head a rough idea of what you should come to the table with in terms of closing costs. And then lastly, I'm going to talk about what they call EMD or earnest money deposit. So getting into down payments. Well, what is a down payment? Down payment is an amount of money, a lump sum of money that you use to secure financing through a lending organization or through a financial institution. Now, there's one caveat about this down payment and the closing costs. That money that you have that you're going to come to the table with to use to initiate financing on a home needs to be what they call seasoned. All right. And what that means is the money, you actually have to have that money in a secured bank account or trust account or some type of financial institution where you have bank statements to prove that the money has been in that account for up to 4 months. Now, there are a lot of legal reasons why that's necessary, which is way beyond the scope of this particular video. So if you have any questions specifically about seasoned money, please direct them to your lending professional and your loan officer, and they will gladly help you out in that regard. So basically, when you are securing a loan through a financial institution, through a lending agency, through a mortgage broker, whatever you want to call them, you need to come up with what they consider a down payment. Now, there is many different specific loan products and lending products that are offered to you that, again, your lending agent will help you out with. Now, depending on what lending product you choose will determine the amount of down payment that particular lending product requires, okay? So, essentially, the way that'll work is, let's say that you put an offer in on a house for a specific amount of money. Once that offer is accepted, the consideration for that house is whatever that dollar amount is in exchange for a legal title of that property. So what you're going to do is, depending on that amount of money, depending on the lending product that you choose, you're going to put a percentage of that money and you're going to hand it to the bank, which is going to lower the amount of money you actually need to borrow, which is reflected in what's called a loan to value ratio or an LTV. Now that LTV is used for a lot of specific reasons, but it's used basically to govern the constructs of the type of lending product that you specifically purchase and use with your lending agency. So for simplicity's sake, we're going to assume that you're purchasing, let's say the purchase agreement was agreed upon and you're buying a $100,000 home, which, let's just for this equation, because that's a simple math. And your lending product that you choose requires a 20% down payment. So 20% of $100,000 is $20,000. So if you take $100,000, subtract that down payment at $20,000, that'll leave you with $80,000. So basically what you're saying to the bank is, Mr. Bank, I would appreciate if I could borrow $80,000 so I can finance this $100,000 home that I want to purchase, is essentially what you're doing. Now, this number equates to an 80% LTV. Now that number right there is extremely important. First off, the lower that number is in real estate terms, 80% or lower is considered really good. So if you have a 80% LTV or lower, it's advantageous to everybody involved. It's advantageous to you, the buyer. It's advantageous to the bank. And in many cases, it's even advantageous to the seller. So what happens is if it's 80% LTV, the bank assumes less risk. So if you were to foreclose on the house and default on the loan, and the bank would obtain the property back from you, and they would have to sell it, essentially they want to sell it for $80,000 or more so they can recoup the amount of money that they put forward to loan you the money for the house. And so at 80% or lower, the bank assumes less risk for that type of situation. And because they assume less risk, and again, I'm not a lending professional, but in many cases, the bank will reward you by giving you a lower interest rate. In some cases, not in all cases, but sometimes you might actually get a lower interest rate. And that's beneficial to you as a buyer. It's also beneficial, like I said, because your monthly payments are going to be lower. You have more equity built in the house, so it protects you as a buyer as well. So in the event that you have to sell your house, again, the amount of money you have up front, it's easier for you to recoup that money the same way as it is for the bank. So it's beneficial to have a LTV ratio of 80% or lower. But in many cases, 20% is a lot of money to put down on a house. So there are a lot of lending products out there that help the home buyer that doesn't have 20% down payment, and they actually will allow them to use a lower down payment. In a lot of cases, that equates to about a 3% down payment. And again, it depends on the lending product that you are working with the lender. But assuming that you only put 3% down, that'll bring your LTV up to a 97% LTV. Now, based on what I just said about the 80%, 97% LTV is not very advantageous to the bank. It puts the bank in a very tight situation, a very nerve-wracking situation, and their risk is a lot higher than it normally would be. So with that higher risk, a lot of times they will charge what is called PMI, which is it's mortgage insurance. Now that PMI covers the lending institution in the event that you default on your loan. They will recoup the cost through the insurance company that they have out on that loan. So what ends up happening is, so whatever your monthly mortgage payment is, which typically that money, well, there's a lot of times your taxes and your homeowner's insurance is also escrowed into that. But for simplicity's sake, let's just say that your mortgage payment is just paying for the interest and it's just paying for the principal balance of the loan. Now, if you are above 80%, they're going to ask you to pay that insurance premium. So in addition to your monthly mortgage payment, you will also have to pay an additional amount of money that's going to go towards this PMI, which is going to cover the bank in the event that you default on your loan. So that's why it's very important to really understand the ins and outs of down payments and how they affect the loan-to-value ratio. And then depending on the loan-to-value ratio, you can talk to your lending professional and find out how that'll affect your specific loan product. Okay, you're also going to need money to cover your closing costs. All right. Now, closing costs vary from transaction to transaction and situation to situation. And me as a realtor, 9 times out of 10, the realtor doesn't have that information. And granted, realtors are here to serve you, so we can get that information for you. But who does have that information is your lending agency and a lot of times the title company that's working with your specific closing. So you can obtain that information as to what your closing costs will actually be through your lending agency. In fact, the lending agency is required by law to provide you a breakdown of where the closing costs are going and how much they're going to be. So just keep that in mind that you will have a breakdown of that. But what I can tell you as a realtor, when you are searching for a home and deciding what home you want to purchase, and you are looking at how much money you have to put down and how much money you have to use for closing costs, in the state of Michigan, where I'm licensed, I can't speak for other jurisdictions, but for where I'm licensed, It's a 6%. Okay? It's 6% is the maximum amount that a closing cost can be. So on a $100,000 home, $6,000 is the highest amount that you will potentially pay for closing costs. Maybe lower, but definitely not higher. And it's not always $6,000, it's 6% of whatever the value of your home is. So when you are out there searching for a home, assuming a 20% down payment, basically if you multiply 26%, so 0.26 times the value of the home that you're looking to purchase, that'll give you a rough idea as to how much you're going to have to come to the table with. In a lot of cases, it's actually less because your closing costs are going to be less. Again, if you want specifics, though, you want to talk to your lending agency, and they will be able to help you out with that type of information. So that's how that all comes together. Now, last and definitely not least, there's what's called the EMD, the Earnest Money Deposit. Now, that's exactly what it is. It's a deposit. But the purpose of an earnest money deposit is it's a good faith gesture you're extending to the seller of the home. Basically, it shows the home seller that, yes, I'm interested in your home and I fully intend to carry out the constructs of the contract we are signing. And a lot of times having an earnest money deposit helps the seller make a decision whether or not they want to accept your offer. Are earnest money deposits required in the industry? No, they're not. Are they recommended? Yes, they are. It's a standard in the industry. So in 9 times out of 10, a real estate transaction is going to require an earnest money deposit. Now, keep in mind, it's money that you are going to pay regardless. You're just paying it ahead of the game. You're just paying it ahead of time. So, for example, if you have $6,000 in closing costs and your earnest money deposit is $2,000, you need to come to the closing with $4,000 for closing on top of your down payment. So basically the $2,000 earnest money deposit you gave to your broker at the beginning of the transaction will essentially, that money has to be deposited within the real estate broker's account within 2 days of receiving that money. And when it's in that account, it's a escrow, separate trust account that the real estate broker has that's not commingled with their operating expenses. It's separate there, and that money is earmarked specifically for your closing. So you will use that money at the end. Now, a lot of people say, okay, great, I put this money up front. Can I get the money back? Like, what do I do with this? What happens to this money? So it's a two-pronged approach. Yes, you can get that money back, but the other side of the coin is, yes, you can actually lose the money as well. Now, the only way you're going to lose that money, though, is when you sign the purchase agreement and you decide that you're going to exchange the consideration of whatever amount of money you're going to use in exchange for a legal title of that property. When you make that decision and you sign the dotted line and you date it and you say, look, I am now locked into this contract. If you breach that contract illegally for any way, shape, or form, you'll essentially lose that money, and that money will actually go to the seller. Now, when I say illegally break the contract, that's the key construct. So within a contract, there's a lot of complexity to it. There's a lot of guidelines, and there's a lot of, in real estate transactions, there's a handful of what they call a contingency. So this contract hinges contingent upon such and such condition, and I'll get into a little bit more specifics shortly. So if you follow the construct of that contract and you get out of the contract legally, your earnest money deposit will be refunded to you, and you can continue to shop and look for another home, and you won't lose that money. So there's a few other times during the closing process where there's a contingency, but an example I'll give is there's what's called the inspection contingency of a contract. So during that inspection contingency, you have a agreed upon amount of time that's written in the constructs of the contract that says, during this time frame, the home buyer has the option to investigate the property through a licensed home inspector, et cetera, et cetera, et cetera. And in that construct of that particular contingency, there's an option where at the end of that, the buyer can say, well, I'm not satisfied with the condition of the property. And if that's the case, under that constructs of that contingency, they can actually back out of that contract and say, whoa, I don't want to buy this house because of this or because of that. And if they do that, under the constructs, they will have their earnest money deposit refunded to them. And as I said, there's a couple other contingencies within the contract that we're not going to cover right now just for the sake of time. My next video, I'm going to get into more specifically the actual closing process, at least a general view of it and how it applies to the home buyer. I hope this information was valuable to you, and if it was, do me a favor and subscribe to this YouTube channel and like this video. And secondly, if you are in the Detroit area and you are in the market to buy a home or to sell your home, feel free to reach out to me at joerealdeals@gmail.com. I will leave the email address in the description below, and I look forward to having the opportunity to apply for the job of being your realtor. And remember, real estate is what I do.